Assalamu alaikum. Hello everyone. Today inshallah we're going to be learning about chapter 13, which talks about current liability, provision and contingencies. So this chapter is not a new concept for you. You've learned this in Introduction to Accounting too, but we will learn let's say in depth today inshallah, and this is really important chapter. If it's not for now, it will be really important in the future, so I suggest you to focus and write some notes with me. So, first of all, what is a current liability? Current liability is something happened in the past. Okay, maybe we've purchased something, maybe we've taken a loan, maybe someone have performed services for us and we didn't pay for it, which results, let's say, a present obligation, and it will, let's say, we have to sacrifice some economic benefits in the future. So it is a present obligation arise from a past event, okay, and because of it we have to maybe pay some cash or maybe provide goods or perform a services in the future. Okay, so saying that a current liability is reported if one of two conditions exist. So unless the liability is expected to be settled, which means paid within its normal operating cycle, and you'll probably ask, what is an operating cycle? Let me give you a first reminder, is that, let's say, for example, that we are a retailer, for example, Walmart's. What Walmart do is that they will purchase an inventory, okay? They will purchase an inventory, and then maybe they will put it in a shelf, and then they will maybe market that inventory for their customer, and then the customer will sell those inventory, and then maybe they will have an account receivable, and then they will collect some cash from their customers. Okay, so this, it's called an operating cycle, which means it is the period of a time elapsing between the acquisition of the good and services and the final cash realization resulting from sales and subsequent collection. Okay, or the other, let's say, condition is liability is expected to be settled within 12 months after the reporting date, which is within 12 months of the reporting day. So unless one of those conditions are met, it's considered as a current liability. And there is, let's say, a really important point is that we will pay our current liability from our current asset, which means if we paid for our current liability from any other different things other than like a current asset, is not considered as a current liability. Let's say, for example, that we've had a current liability, and when we look at our current asset, we didn't have enough cash, we didn't have a cash equivalent, or we didn't have enough inventory or something. Our current asset cannot cover our current liability, and we've decided to take a long term debt, a long term, like a loan from the bank, and we've paid for that current liability. In this case, is not considered as a current liability, since because we didn't cover that current liability from our current asset. So any other source that we will cover for our current liability than the current asset, is not considered as a current liability. Okay, and we have different type of a current liability. We will look at the accounts payable, which is, you probably heard about it a lot, and sometimes we call it trade account payable. Maybe we've purchased something, goods or supplies, or maybe services on account, and because maybe we've purchased something and in the future we'll pay for it, so there is a time lag between the acquisition and the payment. And usually the seller will say, if you pay us within maybe 10 days, or you'll have like a discount over 2% or 1%, and usually the net due is for 30 or 60 days. Okay, and we look for account receivable, which is from the seller perspective in chapter 7, so this is also not a new concept. And then we have notes payable, which is usually like more than the accounts payable period, when maybe we don't trust that customer, or maybe the period of a time is more than 60 days. So it's a written promise to pay a certain sum of money on a specific future dates. So maybe we've purchased something, maybe we've taken a loan, maybe any other transactions, services or something, and it's classified as a short-term or a long-term notes payable. But because we're talking about current liability, which means we will focus only on short-term notes. And that note could be interest-bearing or zero interest-bearing notes, because remember, in the notes, the interest could be stated in, which means it's shown in the notes, or it could be not stated, which is a zero interest-bearing note. So here we have an example of interest-bearing notes. We have Castle Bank agrees to lend 100,000 on March 1, 2019 to Landscape. If Landscape sign 100,000, 6% 4-month note. Landscape require the cash received on March 1. So in March 1, we are Landscape, and we've taken a loan from a bank with $100,000. So we will debit cash since we've taken a loan, and we will debit notes payable since it is considered as a liability. And then if Landscape prepare financial statements semi-annually, so semi-annually, which means they are preparing their financial statement every 6 months, okay? It makes the following adjusting entries to recognize the interest expense and interest payable at June 30. So from March 1 till June 30, 4 months have been passed. And now we have, because they are preparing the financial statement, they have to recognize the interest. So 100,000, which is the principal amount, multiplied by 6, which is the interest rates, multiplied by 4, which is only 4 months have been passed, divided by 12, because the interest is annually, but because they are preparing the financial statement semi-annual, so we will divide it by 12. Okay, so then the interest is going to be 2,000. We will debit interest expense and credit interest payable. And then at maturity, which is in July 1, 2020, which is the time that we have to pay back the principal plus the interest. So we have to record the payment of the notes. So we will debit notes payable, which is the principal amount that we've took, and the interest. And then we will credit the cash because we will pay the amount for the notes and the interest. And then we have another example for zero interest bearing notes. Just to give you a quick reminder that the zero interest bearing notes, today I will give you the present value of the notes, and in the future you'll pay me the fair value of the notes, which is I will give you the amount with the discount, and then in the future you will pay the amount at a premium. Okay, so on March 1, Landscape issued 102,000 4-month zero interest bearing notes to Castle Bank. The present value of the notes is 100,000, and now we have to record the receipt of that loan on March 1. Okay, so since it is zero interest bearing notes, so today we will receive the present value of the notes, which is $100,000, would be cash debited, and we'll credit notes payable with 1,000. And then same an example here is that semi-annually we are preparing the financial statement. So only 4 months happened past, but it doesn't matter because if you subtract the difference between the present value and the fair value, you will get the difference, which is the interest rate, so which is the 2,000. So you will debit interest expense and credit notes payable, and then at maturity you will pay the fair value of that note. So you will debit notes payable of 102, and you will credit cash. And this is the only difference when it comes into interest notes, is that if the interest is stated, you will pay at the end. You will pay the amount plus the interest, and you will have like a difference account for the interest and the principal amount. But zero interest bearing notes, you will pay the full amount plus the interest, because the interest is hidden with that principal amount, with the present value of that note. So you will debit notes payable and you'll credit cash. And here we have an examples, let's say for account and notes payable. So we have here in September 1, we've purchased an inventory from Orient Company on account for 15,000. The Derby record purchases gross and use the periodic inventory system. So remember, in the inventory system, we have two ways, the periodic and the perpetual system. In the periodic system, we don't update our inventory account. Instead, we will have like a temporary account called purchase. So we've purchased those inventory, but on accounts. So we will debit purchase accounts instead of inventory because we're using periodic system. And we'll credit accounts payable because we've purchased on accounts. And then we have in October 1, we've issued a 15,000 12-month 8% note to Orion in a payment of accounts. So now instead of paying on accounts, a month happened past and we decided to exchange the account with the note. So we will debit accounts payable as if we are paying, but we didn't pay. Instead, we will exchange it with the note. So we will debit accounts payable and we'll credit notes payable, which means that we've exchanged the notes with the account. And then in December 31, because now we have a note and there is an interest, so at the end of the year we have to pay that amount. So 15,000 multiplied by 8%, and only from October to December 3 months have been passed, so 3 divided by 12, it's going to be 1,000. We will debit interest expense and credit interest payable. And then on October 1, we've borrowed 75,000 from the Shore Bank by signing a 12-month zero interest bearing 81 notes. So now, because it's a zero interest bearing notes, they gave us the present value and the face value of that note. So which means that today we'll receive the present value of the note, which is 75,000 cash debit and credit notes payable. And then at the end of the year, which is December 31, 3 months from October till December, 3 months have been passed. So the difference between the present value and the fair value is the interest rate, but only 3 months have been passed. So the 6,000 multiplied by 3 divided by 12, you will have 1,500, which is interest expense debit and credit notes payable. And then we have current maturity of a long-term debt. So let's say, for example, that we have a mortgage. That mortgage may be for a year and 4 months. Okay, so this is year 1, 2020. Okay, and we have 2021. Okay, so let's say that we are paying every month $100. So this is 1, 3, 4, 5, 6, 7, 8, 9, 10, 112. Okay, every month we're paying $100. Okay, and the next year we have only 4 months to pay, which is $400 for only the 4 months, and this is for 12 months. So what's happened is that this is considered as a long-term debt, which is for more than 12 months. But when the first years end, now we have only 4 months to pay for this portion. So now, because this long term, it will mature currently, so this 400, it will be shifted from a long-term debt to a current liability. Okay, so only this 400 will be shifted from a long-term debt to a current maturity. So saying that it's the current maturity of a long-term debt, it's a portion of bond or mortgage notes or any other like long-term that matures within the next fiscal year. Okay, but we have an exception. The first exception is that if we retired by asset accumulated for this purpose that probably have not been shown as a current asset. What's happened is that, let's say that we have a mortgage, but instead of paying from our current assets, we've exchanged it with a land. Land is considered as a non-current asset, and because we are paying for non-current asset, it is not considered as a current liability. Okay. The other items is that we've refinanced or retired from the proceeds of a new long-term debt issue. Let's say that we have a mortgage. Instead of paying from our current asset, we've taken a loan from the bank to pay that mortgage. This scenario is not going to consider as a current liability. Why? Because we didn't pay from our current assets. The third item is that converted into ordinary shares. Also, we didn't pay from our current asset. In this scenario, is not going to consider as a current liability. And then we have short-term obligation expected to be refinanced. So we have some short obligation. It's going to be refinanced and it's considered as a current liability. But also we have two exceptions. The first scenario is that must intend to refinance the obligation on a long-term basis. And this is what I explained before, is that if we take in a loan, that loan was for a short term, only maybe like less than 12 months, to pay for that liability, for that current liability is considered as a current liability. But if that loan is for more than 12 months, which is for a long-term obligation, it is not going to consider as a current liability. In this case, it's going to consider as a non-current liability. The other scenarios is that must have unconditional right to the first settlement the liability for at least 12 months after the reporting date. So let's say, for example, that we've purchased an inventory. When we received that inventory was defective. So we've resent it to the seller, and the seller have said, okay, because it was defective, I will fix it, but it will take more than 12 months. And because of that, you don't need to pay me this in this 12 months. You could pay it within next year. In these scenarios, it's not going to consider as a current liability because we have unconditional right to the first settlement of the liability for at least 12 months after the reporting date. And here we have, let's say this is an example of refinancing of short-term debts. Here we have the CFO for a young corporation is discussing with the company chief executive officer issues related to the company's short-term obligation. So they have an issues related to the company's short-term obligation, okay? Presently, both the current ratio and the asset test ratio for the company are quite low. So we have the current ratio and the asset test ratio, which is comparing the current asset and the current liability. The current maybe asset is less than the current liability, which means they have like some issues facing those obligation. And so the chief executive officer is wondering if any of those short-term obligation could be reclassified as a long-term. So we have two short obligation, and the officer is just wondering if we could have converted from a short-term obligation to a long-term obligation. Okay, so the financial reporting date is December 31, 2018. So when do you report those two short obligation? In December 31, 2018. So the two short-term obligations were discussed, and the following action was taken by the CFO. So indicates how those transactions should be reported at December 31, 2018 on Young's Statement of Financial Position. So the first short-term obligation, which is short-term obligation 1, which is that Young has 15,000 short-term obligation due on March 1, 2019. Which means that we've reported that obligation in December 31, 2018, but the payment due is on March 1, 2019, okay, by 15,000. The CFO discussed with its lender whether the payment could be extended to March 1, 2021. So now they are, just wondering and discussing if there is any possibility to extend it from March 1, 2019 to March 1, 2021. Provided Young agrees to provide additional collateral, so they've agrees, and because they will extend the payments, they will provide additional collateral. So the agreement is reached on February 1, 2019. So they agreed in February 1, 2019 to change the loan terms to extend the obligation maturity to March 1, 2021. Okay. And the financial statements are authorized for issuance on April 1, 2019. So in December 31, 2018, we've reported the liability of 15,000. Okay. And then we've had an agreement, okay, to exchange that payment, extend that payment to February 1, 2019, okay? So first of all, we've reported that liability, and then we've had that agreement, okay, after a couple of months, okay? And then the liability due for payment was in March 1, 2019. And then the financial statements are authorized for issuance with issues that statement in April 1, 2019. The idea here is that these 15,000 is still going to consider as a current liability. Why? Because first of all, we've reported that liability and then we've had that agreements, okay? In this case, it will still consider as a current liability, okay? But the other short obligation, which is short obligation B, is that Young also has another short-term obligation of 120,000 due in February 15, 2019. And its discussion with the lender agrees to extend the maturity date to February 1, 2020. So the agreement is signed on December 18, 2018, and the financial statements are authorized for issuance on March 31, 2018, which means we've reported that liability in December 31, 2018. But we've agreed before reporting that liability, which is in December 18, 2018. In this case, okay, and then we've had that liability due for payment, and then we've issued that statement. Okay, but in this case, because we've had an agreement before reporting that liability, it will be converted from a short-term obligation to a long-term, which is non-current liability. Why? Because let's say, we've had that agreement before reporting that liability. And then we have dividends payable, which is an amount owed by a corporation to its stockholder as a result of a board of direction authorization. So, sometimes the company will declare dividends, and if they declare dividends, it will generally paid within 3 months. So they will pay them like within, sometimes five months, sometimes 3 months. And also, accumulative preference shares are not recognized as a liability if we did not declare. لما نعلن عن الأرباح, it will recognize as a liability. If we did not declare those dividends, it will not consider as a liability for the company. So dividends payable in the form of additional share are not recognized as a liability. So let's say, for example, we've each stockholder maybe have like 100 shares, and each shares will paid $1. So, but instead of paying them $1, we've decided to give them additional share. Those additional shares is not considered for the company as a liability. Instead, it will be reported in equity. And then we have customer advance and deposit, which is considered as a returnable cash deposit received from customers and employees. So let's say, for example, that you have like an asset and you just want to make sure that the customer will return back that asset, or maybe if they bring it back, it won't be defective or something. So you will ask your customer to pay some advance, or maybe we have like a security deposit, and if they bring back those assets, you will pay them back those advance. So it's considered as a returnable cash deposit, and it will consider for the company current liability, because they have to pay it back if the customer bring those assets. So it's considered as a returnable cash deposit received from customers and employees. It may classify as current or non-current liability, just depend on the period of time. Okay, and then we have unearned revenue, which is payment received before providing goods or performing services. So we have some type of a business where you have to pay them first, and then they will provide you the goods or performing the services. For example, we have airline. So you'll pay for the ticket first, which is the company will receive the cash, and then they will provide you the services. Or maybe magazine publisher, hotel, auto dealer, retailers, all these type of business, they will receive the payment first, and then they will provide you the goods and services. So for the company, it's considered as a current liability till they provide you the goods or perform the services. Okay, so here we have an example. Sports Pro magazine, they sold 12,000 annual subscription on August 1, 2019 for €18 each. So we have 12,000 magazines, each one of them worth €18. So they've received the cash on August 1 by 12,000 multiplied by 18. So we'll have 216,000, and we'll credit unearned revenue because for the company it's considered as a current liability. They didn't provide that magazine to the customers. Okay, and then prepare the Sports Pro August 1, 2019 journal entries and December 31, 2019, which is at the end of the year. They will provide those magazines to their customers, and it's considered as an annual subscription. Okay, so on December 31, which is at the end of the year, we will debit unearned revenue because our liability will reduce because we provide those magazine to our customer, and we'll credit subscription revenue, which is considered as a sales revenue because now we are making an earn from our unearned revenue. Okay, so but by how much, which is 216,000 multiplied by 5, because only from August 1 till December 31, only 5 months have been passed, and it's considered as an annual subscription. So we will divide 5 by 12, and you're going to have 19,000. Will debit and earned revenue and credit subscription revenue. And then we have sales and value added tax payable. And what happened here exactly is that when a company make a sales, say a part of it will go to the government, which is as a sales tax, or sometimes we call it the value add tax, which is VAT. So it just like a purpose is to generate revenue for the governments, and there is two system use different method to accomplish this objective. We'll see now the difference between the sales tax or the VAT. So here we have an example of sales tax payable. We have Hello Supermarket sells loaves of bread to consumers on a given day for 2,400, assuming a sales tax rate of 10%. So the Hello Supermarkets makes the following entry to record the sales. So now they've make a sales of 2,400 plus 10% sales tax. So the supermarket will credit sales revenue of 2,400 plus 10% from 2,400, which is 240. It's going to be considered as payable because we have to pay it for the government. So at the end, the supermarket would collect 2,640, which is debit cash. And here we have another example of value added tax payable. So saying that the VAT is collected every time a business purchases a product from another business, the product supply chain. You will see now the example, you will get the idea. So we have Hill Farms Wheat Company grows wheat and sell it to Sunshine Baking for 1,000. Okay, so we have here a company, say a farm, Hill Farm. They grows the wheat. يزرعون القمح, and then they will sell it to a Sunshine Baking. يرسلون المخبز, so they will sell it to this baking with €1,000. Okay, so and also 10% will go to the government. So we have sales revenue. The Health Farms will record it as a sales revenue of 1,000 since they sell it to the other companies, which is for the baking. And then we'll have value added tax payable, which is 10% from that sales will go to the government. So at the end, the company will, the farm will collect 1,100 cash. And then the Sunshine Baking, which is المخبز أخذ القمح, عمل العجينة وسوى هذا البريد, then it will sell it to the supermarket. Okay, so now the Sunshine Baking makes loaves of bread from this wheat and sell it to Hello Supermarket for 2,000. بيرجع برضو يبيعها للسوبرماركت. So Sunshine Baking makes the following entry to record the sales, assuming the VAT is 10%. Keep in your mind is that we've already paid for the government 100. Okay, from that wheat. Okay, so now because we've sold it with the 2,000, we'll credit sales revenue 2,000, and the VAT is only 10%, which is from that sales, so it would be 200. But remember, 200, we've already paid 100 from that 200, so we will remit that 200, and we are only going to pay 100 additional to the government because we've already paid from that 200 in the previous sales. Okay, and then here the House Supermarket sells the loaves of bread to consumers for 2,400. So now at the beginning كان عندنا القمح, أرسلناه المخبز عملوا bread, بعدين أرسلوا للسوبرماركتس, فالعملية الشراء صارت 3 مرات. So now السوبرماركت برضو راح يبيعوا للconsumers. So Hello Supermarket sells the loaves of bread to consumers for 2,400. The Hello Supermarket makes the following entry to record the sales, assuming the VAT is 10%. So now we will also credit sales revenue since we've made a sales, and we will credit value added tax payable with 240. But remember, we've already paid 200 to the government. Okay, and now from 240, only 40 was left to pay for the government, and we'll debit the cash of 2,640. Then we have income tax payable. So businesses must prepare an income tax return and compute the income tax payable. So what happens is that the company would have estimate their profits every quarter, and based on it, they will pay some taxes to the government. So let's say that this is the year. The year have 4 quarters, 1, 2, 3, and 4. So the company will estimate every quarter what is their profit, and based on it they will pay some taxes. So these taxes considered as a current liabilities, and the corporation must have make periodic tax payment. And there's a difference between the taxable income and accounting income, and sometimes occurs, and you will take this in chapter 19, which is intermediate accounting 2 in depth. Okay, so here we have employees related liabilities. So there are some related liabilities for employees, which is since the company will pay for their employees' salaries and wages, it is considered as a current liabilities. And those is considered also payroll deduction, compensated absences, and bonuses. Because remember, when we're talking about payroll deduction, the employees won't receive the gross amount of that salaries. For example, if an employee has a salaries of 10,000, he won't receive the full amount of 10,000. It will be deducted. Part of it maybe will go to the insurance health company. A part of it will go to the government. Some amount, that amount will be deducted, and at the end, the employee would have received the net salaries of that 10,000, which is after the deduction. Okay, so here we have just some small taxes, which is social security taxes. It's used in U.S. Countries, and we have income tax withholding, which is based on your income. There are some taxes would be held and paid also for the government. And here we have two perspectives, because you will pay some amount as an employee, and there is also from the employer perspective, which is the business. They have to pay some taxes, which is social security taxes. If you don't know what is social security taxes, which is the US will have let you pay some certain amounts for like retirement people or maybe disabilities people, just a way for support. So based on your also salaries, they will deduct some taxes. So for the employee perspective, you need to have to pay income tax withholding and social security taxes. For the employer perspective, you need to have to pay social security taxes. For the employer, which is the business, they will report those as liabilities until it's remitted, which is until they pay it to the government. Okay. Here we have an example. Assume a weekly payroll of 10,000. Okay. Entirely subjected to social security tax, which is 8% from that payroll would go to the social security, with income tax withholding of 1,320. So this amount will be withheld, and the union duties of 88 euro deducted from that payroll. So the company record the wages and salaries paid, and the employee payroll deduction is follows. So now we have a 10,000, which is the payroll, which is the wages and salaries, and for the company is considered as an expense, so they will debit 10,000. And now we have some payable we have to pay for the government, which is 1,320, which is considered as a withhold taxable payable. And we have also 8% from that 10,000 considered as a social securities will be credited to. And then we have also union duties payable with 88. And then if you add up all these and deduct it from the wages and salaries, you will have the cash. This is how much the employees would have received after deducting all these taxes. And then we have compensated absences, which is, sometimes some company, they are legally have to pay their employees some payment for maybe vacation or illnesses, maternity, paternities, journey leaves. All these are legally have to pay them. So it's considered as a current liabilities. We have the visited right, which is the employer has an obligation to make a payment to an employee even after terminating his or her employment. So even if he finish the employment, still the employer has an obligation to make a payment. Also, we have an accumulated right, which is an employee can carry forward to future period if not used in the period in which earned. So for example, if we have like a vacation payment and you did not take it for this year, you can use it for the next year. It could be accumulated. Also, we have non-accumulated right, which is the opposite. For example, some companies will say if you did not use your medical leaves this year, you cannot carry it to the next year. And then lastly, we have profit sharing and bonuses plans, which is, if your employees have making something need to be compensated, which is called like a bonuses. So the payment to a certain or all employees in addition to their regular salaries or wages. So those bonuses for the company is considered as an operating expenses, and unpaid bonuses should be reported as a current liability. So if any of your employees are should have received those bonuses and those bonuses did not paid for the company is considered as a current liability till we pay them to the employee. And then we have a provision, which is in learning objective 2. A provision, it is a liability of uncertain timing or amounts. What does that mean? So let's say there's a big probability, which is more than 15%, that there's an obligation, but we are not certain about the time or the amounts. Let's say, for example, warranty or product guarantees. So we're saying to our customer, listen, if something bad happened to your product, you have 1 year, you could have bring back your product and we will fix it. Okay. In this scenario, do we know how many customer will come back? Do we know the time? Do we know how much it will cost us to fix those products? We don't know. So in these scenarios, we will just, based on our experience, maybe 5% from our customer will come back and we have to fix their products. It could be maybe less, it could be more. It just based on a probability. But here we are talking about more than 50% that those obligation would have occurred. Okay, and we have like different type of a provision, and it could be even like reported as current or non-current, just depend on a period. We have obligation related to legislation. We have a warranty or product guarantee. We have a business restriction. We have environmental damage. We will look at each one of those type. So for recognition of a provision, when do you recognize the provision? So the company occur an expense and related liability for a provision only if the following 3 conditions are met. So these 3 conditions should have met to be able to recognize the provision. The first condition, which is company has a present obligation, legal or constructive, as a result of a past event. Something happened in the past. Maybe a company sued another company, and because of that past event, we have to pay some certain amounts, this is the present obligation. It could be legal, it could be constructive. We will treat them the same. And what is illegal? Maybe if company sued another company, this is called the legal obligation, or it could be constructive, and we will see in a different slide what does a constructive mean. And the second scenario is that probable that an outflow of resources will be required to settle the obligation. And make sure what is a probable mean is that more than 50% that the obligation will be met to settle this obligation. Okay. So if it's less than 50%, we will not recognize the provision. It should be more than 50% which is more likely than not that sacrification will occur. Okay. And then lastly, we have a reliable estimate can be made, which is we could have estimated the amount of the payment. These 3 conditions should have met. If one of them are not met, we will not recognize the provision. 3 of them should have been met to be able to recognize the provision. Here we have an example of a warranty. Santo gives a warranty to its customer related to sale of its electrical products. The warranties are for 3 years. from the date of a sales based on a past experience, it is probable, okay, it is probable, more likely than not, that there will be some claims under the warranties. So since something happened in the past, okay, and there is a probability, which is more than 50%, that they will come back. In this case, we will recognize, and they're saying here is that let's assume that a reliable estimate of the amount of the obligation can be determined. So since those three conditions are met, we will recognize the provision. Okay. And then here we have constructive obligation. What does that mean? So, sometimes some company, they don't have a virtual warranty or virtual guarantee that if something happened to the product, we will do this or do that. But because based on their past experience, if something happened, the company will have taken action. In this scenario, the parties will expect if something happened, those company will fix the product, or maybe they will refund the customers. Okay, although there is no let's say there is nothing is legally stated, but based on their past experience, they got well known for those responsibilities. Okay, so here we have an example of Dior. They has a policy of refunding purchases to dissatisfied customer, even though it is under no legal obligation. So there is no legal obligation, okay? But they have this, generally known that they will refund their dissatisfied customer. Should we recognize the provision? Yes, we will recognize. If there's a legal obligation or constructive obligation, we will treat them the same, okay? So now, since those three conditions are met, we will recognize the provision. And then we have assumed that an employee filed a 1 million lawsuit on November 13, 2019 against WM supermarkets for damages suffered when the employee slept and suffered a serious injuries at one of the company's facilities. So the supermarket's lawyers believe that they will not lose the lawsuits, putting the probability of the future payment at less than 15%. So one of the employees have slept and really suffered serious injuries, and he filed a lawsuit on that supermarket, but the lawyers believing that they will not lose the case, and there is the probability is less than 15% that they will lose the case. And this scenarios, we will not recognize the provision since the probability is less than 15%. Okay, so what is the measurement of the provision? So now we've learned about should we recognize the provision or not, but what is the amount to report the provision? So the amount recognized should be the best estimate of the expenditure required to settle the present obligation. What is the best estimate? It represents the amount that the company would have paid to settle the obligation at the statement of financial position date. And we will look at different measurements that the company could have go for. So the management must have used a judgment, and that judgment based on a past or similar transaction. They will have a discussion with the expert to expect the amount of the liability or any other pertinent information. So we have an example of Toyota warranties. Toyota might have determined that 80% of their cars will not have any warranty costs, 12% will have a subtotal cost, and 8% will have a much smaller cost. In this case, they will weigh all the possible outcomes, and then they will come up with the unexpected value, and they will recognize the provision, okay, their liabilities. We have another example of a Carrefour. Carrefour, they sell a lot of different variety of items, and because there is a continuous range of refunds, they will use a midpoint in the range, which is like a mathematical calculation to estimate the average of refunding their customers, and then they will recognize the liabilities. And also here we have Novartis lawsuit, which is this company is Novartis. Yes, this company is like a pharmacy company, and because of their product, they have a lot of numerous of litigation issues. So what they will use, the most likely outcomes of the lawsuit, it would be considered as the best estimate of their liabilities. So the measurement of the liability should have considered the time value of money. If the amount is materials, they have to consider the time value of money, and also a future event that may have an impact on a measurement of the cost should have been considered. So these are the common type of a provision. We're going to look at each one of them separately. So we have lawsuit, environmental warranties, so onerous contracts, restructuring, consideration payable. So what happens is that if which one of those common type are met those three conditions, we have to recognize the provision. But what happened if the company couldn't measure the amount of the provision? In this case, IFRS requires an extensive disclosure related to provision in the notes to financial statements. The company are required to disclose and explain the whole situation of the provision, but the company do not required to report like every single general risk of contingencies. Okay, so maybe if there's like a war or strike, they are not required to disclose it in the notes. Otherwise, if it's one of those common type, the company, they are required to extensive disclosure in their notes. Okay, so the first type of a provision, which is litigation provision, which is when a company sued another company or filed a claim. Okay, so company must consider the following in determining whether to record a liability with respect to pending or threatened litigation and actual or possible claims and assessments. So to recognize the litigation provision, there's three conditions should have met. The first one, which is the time period in which the underlying cause of action occurred, which is past events have created this litigation. The second scenario is that condition is which is the probability of unfavorable outcomes. Thirdly, ability to make a reasonable estimate of the amount of the loss when we can like estimate the amount of the loss, and there is like a past event and there's a big probability that there's unfavorable outcomes, which is same condition as the recognition of a provision. If those conditions are met, we have to recognize the litigation provision. Okay. So here, what happened if you heard about like a claims or a suit, but for a company will suit another company, but that didn't happen, but it will probably happen in the future, which is with respect to unfiled suit or uncertain claims and assessment. But that will probably happen in the future, which is the degree of probability that a suit might be filed or claim or assessment may be asserted, and the probability of unfavorable outcomes. If the both of those conditions are probable, which is there's a degree that someone will sue us in the future, and there is unfavorable outcomes, and if there is like a loss estimate, we can have estimates the amount of the loss, and if the cause for action is dated on or before the date of financial statements, the company have to recognize the litigation provision, even if that did not happen yet. Okay. So here we have an example of litigation provision. We have a score case is involved in a lawsuit at December 31, 2018. Prepare the December 31 entry, assuming it is probable that Score's case will be labeled for $900,000 as a result of this suit. So since we are liable for this $900,000, we will debit lawsuit loss, which is an expense, by $900,000, and credit lawsuit liability. B, which is prepare the December 31 entry, if any, assuming it is not probable that Score case will be labeled for any payment as a result of this suit. So there is no probability that we will pay more payment for this suit. In this case, there is no entry is necessary. Okay, and then we have warranty provision, which is a promise made by a seller to a buyer to make good on a deficiency of quantities, qualities, or performance in a product. So typically we're just promising our customer if something bad happened to a product, you're not dissatisfied with the quantity, quality, whatever it is, you can come back and we will fix it. Okay, so if it's probable that the customer will make a warranty claims, they will come back and the company can reasonably estimate the cost involved for maybe fixing that products, the company must record an expense. They have to recognize a provision. Okay, and we have two type of warranty: assurance type warranty, which is what I was explaining, which is a quality, a guarantee that the good or services is free from defective at the point of sales. So when we make a sales, we will recognize the sales, but also we will recognize the expense in the same period of time. Okay, and also we will credit the warranty liability. So we will see an example here. Let's me do this in the same. Okay, so here we have a Denison Machinery Company begins production of a new machine in July 2019 and sells 100. Okay, they've sold 100 machine for 5,000 cash by year end. Each machine is under warranty for 1 year, so the warranty is only for 1 year. Denison estimates, based on a past experience with a similar machine, that the warranty cost will average 200 bare units. So he was estimating based on the past experience that it will cost them 200 bare units, and remember we have 100 machine. Further, as a result of a part replacement and services performed in compliance with the machinery warranties, it is incurs 4,000 in warranty costs in 2019. So they spent 4,000 costs in 2019, and in 2020 they spent 16,000. Okay. So now, what is the journal entries for 2019 and 2020? So first of all, because our customer have made a purchase, the company have to recognize the sales by how much. 100 machine, each one of them worth 5,000. So we will have debit cash and credit sales revenue. Okay, but then in July till December 2019, we've had a cost of 4,000. Okay, they've came back and we fixed some those machines. So we will debit warranty expense and credit cash, inventory, accrued payroll, because we've paid some cash. Maybe there is some machine need to be replaced. Maybe those employee need to pay some salaries because they've worked on it. So we will credit cash, inventory, accrued payroll, and then in December 31, 2019, remember we were estimating that the average cost would be 200, and these only for bare units, and we have 100 machines. So this is the original cost. This is the provision expense that we should have recognized, isn't it? So. But remember, only 4,000 incurred in 2019. So 20,000, which is 200 multiplied by 100, will be $20,000 minus 4,000, which is the only cost that was incurred. You'll have only 16,000 is left. So we will debit warranty expense and credit warranty liability, and then next year we've spent 16,000 in 2020 for maybe those also machines. So we will debit warranty liability, since now there is no liability anymore, and this is the end of the year, and also we've paid for that liabilities. So now we have to close that T account. So we will debit warranty liability of 16,000 and also credit cash, inventory, accrued payroll. And then we have the other type, which is services type warranty. So let's say, for example, maybe if you've ever purchased a phone, any company, let's say for example Didi, they will tell you, if you purchase a phone, we'll give you a warranty of 2 years. But if you pay $100, we will give you like additional warranty of 2 years plus. So services type warranty is like an extended warranty on the product at an additional cost. Probably it's not going to be for free. Since you will have an extended warranty, you have to pay some cost. And this additional cost for the company is considered as a revenue. okay, because you're paying additional costs. But the company will not record it as a revenue at the beginning till the warranty is expired, and then they will make an earn from that warranty. So usually recorded as unearned warranty revenue accounts, which is a current liability, and recognize revenue on a straight line basis over the period the service type warranty is in effect. So we will see an example to make it more simple. Okay, so let's use this to make it more simple. Okay, so you've purchased an automobile from Hamilton Auto for $3,000 on January 2, 2019. Okay, we've purchased a phone. That phone was for $30,000 on January 2. Hamilton estimate that the insurance type warranty cost on automobile to be €700. So he was estimating that the cost is going to be for $700. Hamilton will pay for the repair for the first 36,000 miles or 3 years. So he will pay for 3 years. This is the period of the wages, or maybe 36 mile. Okay, so which one of them comes first? You also purchase for $900 a service type of warranty. So we've also purchased additional services type warranty for $900. For additional 3 years or 36 miles, Hamilton incurs a warranty cost related to the insurance type warranty of $500 in 2019. So in 2019, we came back and he's paid $500 on that cost, and $200 in 2020. Now, to record the transaction for 2019 and 2022. First of all, we've made a purchase. We've purchased that phone. So for the company, they will have a cash, isn't it? By the mobile original cost plus the insurance, the services type warranty. So they will have cash of both of them. But also they will have an earned warranty revenue, which is considered as a liability of that additional services warranty. And also they will have a sales revenue of only that phone cash, because they cannot recognize their revenue for the additional cost till the warranty is expired. Okay, and then in January to December 31, 2019, we've came back and we've asked to maybe repair or fix that phone. So for the company, they will debit warranty expense and credit cash, inventory, accrued payroll, same as insurance type warranty. And then here also the same thing is that he was expecting that $700 it will be the cost for those automobile. But also in the first year, we've only incurred $500. So 700 minus 500, you have 200 is left. You will debit warranty expense, credit warranty liability. And then in December 31, 2022, we will make an earned from that unearned warranty revenue. But also we are using this straight line method, which is this 900 will be divided by 3 years, because that's for 3 years that's warranty. Okay, so we will have a warranty revenue, which is sales revenue of 300, and we will have an earned warranty revenue credited just to close the current liability account. Then we have consideration payable, which is companies often make a payment to provide consideration to their customer as a part of a revenue arrangement. So, sometimes company, they want to increase their sales, attract their customers, so they will offer like a premium, coupons offers. You're paid, for example, if you've purchased like $100 from our store, you'll have $10 additional. You could have paid whatever you want, purchase whatever you want. So for the company, in perspective, for them it's considered as a liability, it's considered as a cost. So the company should have charged the cost of premium and coupons to expense in the period of the sale that benefits from the plan. So here we'll have an example of consideration payable. So let me use this. Okay, so here we have a fluffy cake mix, sells boxes of cake mixed for €3. Okay. In addition, Fluffy Cake Mixed offers customers a large durable mixing bowl in exchange for €1 and $10, which is for $10, you have to pay only €1, okay, instead of €3. The mixing bowl costs fluffy cake mix €2. So the original cost is €2, but you're offering your customers €1 for $10. And the company estimate that the customer will redeem 60% of the box tops. The premium offer begins in June 2019, which is in the middle of the year. During 2019, Fluffy Cake Mix have purchased 20,000 mixing bowl at €2. And also they've sold 300,000 box of a cake mix for €3 per box and redeem 16,000 box tops. So what is the entries for 2019? So first of all, what we've did is that we've purchased 20,000 mixing bowl at €2. So we'll have a premium inventory and we'll have cash since we've purchased that mixing bowls. And then we've sold it to our customer. We've sold to our customer 300 bucks at €3, isn't it? So we will have cash debited and credit sales revenue to consider as a revenue for the company. And then what we did exactly is that we've redeemed 16,000 bucks, 10 bucks for €1, and instead of €2, which is the original cost for the company, now it's only €1. So for the company, they've received some cash, which is about the redeem of €16, which is about 10 bucks, and each of those 10 bucks worth €1. So 16 divided by 10, and then multiply by 1, you will have 6,000. And then, but the original cost was for €2, not €1. So now this is let's say, this is what we should have collect, but because we're offering to our customer only for €1, so we'll have 16,000 divided by 10, multiply by 2. This is the inventory offer premiums. And if you subtract the difference, you're going to have the amount of the expense, which is, this is the amount that the company will lose because of that offer, which is the premium expense, which is 6,000. Okay. Doing that in another way, so this is the total box tops sold in 2019, which is the 300, and they were estimating that 16% will be redeemed, which is, if you multiply them, you'll have 180,000. And this amount of the total estimated redemption divided by 10, which is the boxes that we're offering, multiplied by the original cost, which is 2, and minus the amount that we are offering to our customer, you'll have an 18,000. But also we've here calculated, this is the premium expense. This is how much we are going to lose. If you deduct from it, you're going to have a liability at 2019. And also this is only for which is only for 6 months. And this is how we will make a transaction. We will debit premium expense 12,000 and credit premium liability. Then we have environmental provision. So a company must recognize the environmental liability when it has an existed legal obligation associated with the retirement of a long-lived asset, and when it can reasonably estimate the amount of the liability. Simply is that sometimes we can have, some businesses, let's say, they will make an environmental damage, and the cost is to clean up that environmental damage. So for example, we have like decommissioning nuclear facilities, dismantling, restoring, and reclamation of oil and gas properties, certain closure, reclamation, removal of cost of mining facilities, closure and post-closure costs of landfill. So these are an example of damaging the environment, and the cost is to clean up those environmental damage. Okay. So for the measurement, a company also initially measure an environmental liability at the best estimate of its future cost. So the recognition and allocation to record an environmental liability, a company includes the cost associated with the environmental liability and the carrying amount of the related long-lived assets, and record as a liability for the same amounts. So for the disclosure related to provision is that the company must provide a reconciliation of its beginning to ending balance for each major classes of provision, identifying what caused the change during the period. So saying that simply is that provision must be described and expected timing of any outflows disclosure. It should be disclosed. Everything should be clear in the notes and explained fairly. So disclosure about uncertainties related to expected outflows as well as expected reimbursements should be provided. All of these information should be provided in the notes. And then lastly, we have contingencies. So contingent liabilities are not recognized in the financial statement because they are a possible obligation. Saying possible obligation, which means it's less than 15%, it will occur, which is not yet confirmed. A present obligation for which it is not probable that the payment will be made, or a present obligation for which it's a reliable estimate of the obligation cannot be made too. Okay, so saying that, if you look at here, we have the outcomes, we have the probability, and we have the accounting treatments. So if let's say the probability that that obligation would have occurs at least 19%, which is virtually certain, we will report it as a liability, which is a provision. If it's probable, more likely than not, more than 15% till 89%, we will also report it as a liability and also provision. If it's less than 15%, from 5% till 15%, it's considered as possible but not probable. In this case, we will only disclose it in the notes. If it's less than 5%, we will remote, which is we will ignore that amount, which is less than 5%. So this is the outcomes, probability, and account treatment. This is highly important, let's say, guidelines. So I suggest you to just write some notes with it. Okay. And then we have contingent assets, which is, let's say, it's the opposite of a contingent liabilities, which is a contingent asset. It is a possible asset that arises from a past event. So it is a possibility, okay, from something happened in the past, and whose existence will be confirmed by the occurrence or non-occurrence. It might happen, it might not, of uncertain future events, not wholly within the control of the company. Typically saying that the contingencies assets are possible received from money from gifts, donation, bonuses. So it's possible, which is less than 15%, that we will have some gift or donation or bonuses, or maybe a possibility of a refund from the government in tax disputes, or maybe pending court case within probable favorable outcomes. So we have a case lawsuit, and it is possible that we will have a favorable outcomes. So it is considered as a contingent asset. So contingent assets are not recognized on the financial statement or a statement of financial position. Only we will disclose it in the notes, but we will not recognize it in the statement of financial position. So here we have a guidance of a contingent assets. If the probability is at least 19%, which is probable, we are virtually certain, it will be reported as an asset because it is no longer contingencies. The probability is very high. And also we have probable, which is more likely than not, from 51 till 90s. Probable, it will be disclosed only in the notes. And then the possible but not probable, which is from 5 to 50 or even less than that, there is no disclosure is required. Okay. So contingent assets are disclosed when an outflows of economic benefits is considered more likely than not to occur, which is greater than 15%. This is the only way to disclose the contingent asset if the probability is greater than 15%. finally have presentation of current liabilities. So usually it will be reported at their full maturity value, and the difference between the present value and the maturity value is considered immaterials because usually it's like less than a year. And you can see here the presentation of the current liability. This is the current asset, and then you're gonna have the current liability. This is how it's gonna look like in the balance sheet. And then sometimes we use some ratios for the current liability to see, do we have enough current asset? Can we just settle our debts? So these are some ratio that the company would have used for their analysis. For example, current ratio, which is current asset divided by the current liability, or the asset test ratio, which is cash plus short-term investment, net receivable. All these is considered as which is current assets divided by the current liability. These ratio are used for the company for their analysis to make sure if they have any deficiencies or any issues that they will be able to cover within the next period. So yeah, this is the end of the chapter. I hope you enjoyed, and thank you for your listening.